Hello, everyone. It's Brett Stuart with Global AgriTrends. And today we're talking about reasons for optimism from the global pork markets. This is a webinar for the National Pork Board. As I walk through the markets here, I just want to be able to shine a little bit of light. And I know the U.S. hog margins have been difficult. It's been a tough year. So with this, as I look out, I spend my time analyzing global markets. I just wanted to be able to talk to you guys today and say, you know what, it has been a rough go here, but there are reasons, I truly believe there are some reasons for optimism as we look beyond the US market into the global markets. And most of you are familiar with me and what I do. Our firm is Global AgriTrends. We do analysis on the global protein markets, mainly beef, pork, poultry, dairy, grains, etc. And so I spend my days scouring the global news and running global data and looking and trying to keep a finger on the pulse of what's happening around the world. So today we'll talk about US hogs and pork market conditions. And what I want to do is walk through why the margins are where they are. And I think when you understand that, okay, here's the concern, that helps give us an indication of what to watch for in terms of margin improvement. I'll dig in, talk about global hogs and pork. I want to touch just a little bit on climate policy as I look around the world and give you my global perspective on that, and then just end with a summary. So I'm sure most of you have seen the movie Clint Eastwood, The Good, the Bad, and the Ugly, right? That's what I thought about this presentation. I thought there is good. We are seeing global protein and pork liquidation, which is positive as we look forward to future markets. North American pork is very competitive in the global markets. The bad is obviously just where we've been with margins over the last year. And the ugly, misguided activism, policies, and lies. And it truly is. That's the ugly side of our business. The ugly opponents that we have out there. So then I added this, the unknown, the future. And these are always unknowns. This never changes, right? Weather, prices, recession, economy, not much we can do about that other than take a look at it. So let me just start off. This is a chart of the global food indices, and you can see here markets go up and markets go down. And we've been through an incredible super cycle that really began with COVID. And it wasn't just because of COVID, but it was fueled by the COVID money. During COVID, global stimulus totaled somewhere around $17 trillion. The US was about 7 trillion of that. And so as all these governments panicked and pushed money into the economies, that's very inflationary. The creation of money is textbook inflation. So we look at where we sit today, and that bubble has burst. Now, if you look at the trend line there, that dotted line, that's the average for the global food index. The red line is meat. That's beef, pork, and poultry weighted average. But you look at that and where we sit today, we are now 20 points still above where we were before COVID. And so the bubbles burst, prices have come down. 1 year inflation charts, everything's cheaper, right? But when you look back to the pre-COVID levels, that 5-year period before COVID, basically the global food prices are 20% above where they were. And I would suggest we're not going back to those levels. Meat and poultry have been difficult. You can see there, they didn't get the bubble that vegetable oils got or cereals got, the grains. But we definitely are in a spot where we're expecting improvement, especially the next 2 to 3 years. The inflation rates are definitely slowing. So let's shift over and talk about North American hog margins. Who to blame? Here's where we sit. This was the January data from Iowa State. And you can like that data, you can hate that data, but it's what we got, right? And of course, it's an average, and there are people above and people below and a lot of different considerations. This is a cash to cash, so this doesn't include risk management. But you can see there, those January break-evens were still $90. And if you look back into last year, we had break-evens average above 100. And so the January numbers show an $89 break-even, 68 sales price for a loss of $21 a hundredweight. That's $41 a head. And I would suggest that that's going to be the low water mark. And we've all seen that's an easy call, right? It's February now, and we've seen these markets improve. We're seasonally tightening supplies. we're in a lot better spot than we were in January. So January was kind of the dark spot. This is that data. If you throw in their manure credits and stuff, they showed January at $35 a head. Now you can see the seasonality, and we all get that in the hog markets. Summer is the time to make money. And last year, summer was the only time that money was made. This year is not going to track that red line. We're going to definitely trend above it, but we're nowhere near that 20-year average or even the 10-year average, 5-year average. As you can see, those 11 months of the year are typically profitable. And so we're definitely struggling and seeing the weight of these challenging markets and really the weight of high inflationary input costs. So who to blame? Can we blame the consumers for this? You can't really blame the consumers. Look at those price levels. Pork, $4.79 a pound. That was the January print. These price levels are 30% above the pre-COVID average. Consumers have never spent this much on meat. And so if you think about that, we've got good money coming into the industry. The retail store is the gateway of the consumer dollar. And so the fact is, consumers are paying a lot of money. It just isn't enough to come through the chain and catch up and offset all our inflationary pressure. But you can't blame the consumers. This is good news because this, again, is the gateway of money into the industry. Now it becomes a seesaw of leverage. But if you look closely, you can see December saw all three dip just a little bit lower. What about the retailers? What it shows here, in January, the retail pork price was 550% of the cutout. 5.5 times the cutout. Now you can hate that. If you want to go after it, go build a retail store and try to compete, right? It's a pretty big barrier to entry. But the reality is we're not outside of historical ranges. And you can see that number coming down. The historical range is right up there in that 550, 600% at least post 2019. And so, yeah, it would be nice to get that leverage back to the 500% average that we saw the 5 years pre-COVID, 450, 500. But we got to reduce the supplies. And so the way we go after this leverage is we reduce supplies. And then those retailers have to pay up to keep that product. Now, if you look at that chart closely, you can see that there's some seasonality to leverage. And the leverage, the ratio bottoms out in June, July. If you look at that, June, July is the low part. That's where they're not getting as big of a percent and we're getting more. That means we're pulling money past those retailers. And so that's very seasonal. We all know why. June, July is our tightest supply. Those retailers don't have as much pork sitting around. They have to go out and bid for it. And so I would suggest that by the time we get to June, July, we're going to be around that 410%. We're going to get back into those levels. This is significant because, again, consumers are paying way more than they paid in the past for pork. So if we can go get some of that leverage back from the retailer, it'll be more significant than it was pre-COVID because of that big price of the retail stores. All right. Well, maybe we can blame ourselves. Take a look at this. Here's the change. This is the cumulative change in U.S. pork production versus U.S. pork exports. And so today, what this chart tells us, we have about 3.4 million tons more pork than we had in the year 2000, and exports have grown 2.5 million tons. You can see what that means, right? We have put more pork on our domestic market. And really, 2014, those record profits set off rapid expansion. And we definitely overexpanded from what our export markets can absorb. And so, yeah, we have definitely put a lot more pressure on Americans to try to keep our margins right. And we've maybe overcooked that a little bit. So that's some of the blame, right? Some of it is just simply we have plenty of pork. And liquidation has been tepid at best. We're not really cutting that much. But the real villain in this story is right here. It's the feed cost. If you look, this is the Iowa State data. The feed cost was $75 a head those 5 years pre-COVID. It jumps up to almost $130 a head during COVID. So that price move, we bump up the cost of a hog $60 a head just on feed cost. Now, the good news is just from that high last fall through January, we've shaved off $28 a head, but it's still $103. And so this is the problem. This is what's weighing on these margins. Yeah, we've got an abundant supply of pork, but like I showed you, consumers were paying retail record high prices in November it isn't the consumer's fault. And it really isn't totally our fault because they're eating it all and they're eating it all at higher prices. The problem is we have not been able to absorb this heavy feed cost. And we all know where that's headed. You can look at corn futures, where this corn market continues to grind down and grind down. You know, we've got a 3 in front of some of these corn numbers now. This is going to provide more relief. We're getting closer. It takes time for those cheap corn prices to roll all the way back to the farmer because you got to go through and get your old inventory gone and get that cheaper inventory in. But we're going to get some more relief here as we go into summer. Global hogs and pigs. Here's something that's interesting. Now, I've been analyzing these markets for most of 30 years, 25 years. And I've never seen a situation quite like this. Right now, 24, 25, where we are, Australian cattle and sheep are both in liquidation. It's drought driven. It's due to margins, low margins. They're both liquidating. U.S. cattle, 3 years of drought, we've now cut the herd 10%. We are going to see a significant tightening in U.S. beef supplies in 2024. We think that there is going to be a huge price move higher for cattle and beef into 2025. Now, that's not one for pork, but it's not bad news for pork either. Beef is going to get much more expensive. In our hog market, financial losses 12 out of 14 months. That generally leads to liquidation. And so the U.S. hog market is in a very soft liquidation right now. Chicken processor margins, they had losses 11 of the last 16 months. You can look at egg sets. Those egg sets have been lower. Brazilian cattle, for the first time in 20 years, Brazilian cattle is now in liquidation. Their slaughter numbers were up 20% in Q4. And we've got good data now to confirm it. The Brazilian cow herd's in liquidation. Chinese hogs, disease issues, weak demand, they've lost money 2 years now. 23 out of 30 months, they have lost money. They're obviously in liquidation. Now, we never know because we don't know the data. But I can tell you that those kind of losses in China will translate to fewer hogs in China. EU hogs, they have cut significantly, and we're going to talk a little bit about that in detail as we go forward. But big liquidation across Europe. So what I'm telling you here and why this is interesting, the entire global livestock sector is in liquidation all at the same time. These are all in sync. And it's going to be hugely significant to the beef market. It's going to be secondarily significant to the hogs and the poultry markets. But we are going to shift prices higher going forward. And so if I say that's what the supply picture is, where is global demand headed? And you can look there and it's pretty easy to see, right? It's upward and to the right. Global demand is increasing. And I just showed you pretty much everywhere in the world, liquidation is underway. So that tells me higher prices are ahead. That's why we're talking about optimism from the global markets. It's not just the global pork markets, it's the global protein markets are going to blow some tailwinds across the global protein space. Now, if we look at the global sow herd, you can see here we've been in liquidation for 10 years now. And you've got the China ASF, that's the big drop there was the China swine culling. But even beyond that, we're generally producing less sows every year. Now, the problem with the pork markets and the hog industry is incredible productivity. You guys are incredibly productive. And what we've learned is you can produce more pork with less sows. And so that's happening globally. We're seeing productivity increase around the world. And so even though the sow herd's down, productivity is still increasing just a little bit. But you look at the prior trend line and we're not growing like we used to. And so that's supportive to price, right? Less pork. So what about per capita production? If we look at the 10-year change, this is supplies on a global basis. Chicken increases 5%, pork is down 5%. That's global consumption. That suggests there's something changing, right? Consumers are eating less pork on a per capita basis worldwide. Beef is down 10%. And so that liquidation I'm talking about globally, it's also being matched by consumption. Production and consumption on a global basis are the same number. And so you can have that chicken and the egg argument. You can say, are they eating less because we're not producing it? Or are we not producing it because they don't want it, right? And so you can debate that side whichever way you want, but the reality is there is less meat and poultry around the world. Let's shift over to pork. Here's something that's very interesting. We're going to spend more time on this as we drill down into Europe. But look at the 3-year change in global pork exports. Europe's pork exports have now dropped nearly 2 million tons a year. And you can see that big spike. That was when China came into the market. And so, yeah, if you take those big spikes out, they're still declining. There's the US, right? Pretty stable. Brazil, a little bit more. Canada, a little bit less. Again, these are 3-year numbers. Mexico and Chile. But the big story here is that huge drop out of Europe. So global hog prices, I've taken these prices around the world. I've converted them as best I can into a US dollars per hundredweight on a carcass weight equivalent. And if you take a look at that chart, you can see there, the US is by far the cheapest pork in the world, cheapest hogs in the world. Even Brazil has pushed up. Brazilian hogs are about the same price as European hogs. Mexico, China, EU, and Brazil are right close together in terms of total prices. So let's scan around the world here and start off with China. Half of the hogs in the world live in China. And when things shift significantly, we know the impact it can have on global markets. Now, China rode this roller coaster of ASF. ASF was found in China in 2018. 2019 and 2020, they liquidated 2/3 of the swine herd. Prices and margins went through the roof, and then they overproduced. On those high prices, they overproduced. And there you can see those are the losses in China. If you add up really those big losses of the last year, Chinese hog farmers have lost about $13 billion US. Now that's significant. Keep in mind, this is a country that doesn't have lending, right? They're very limited. If you're a hog farmer, one, you don't own your farmland. And if you do, the average farm in China is 1.4 acres. And so these hog farmers can't really go and leverage their land and get a line of credit. When they don't make money, there are no good options. Now, I would tell you with those big hog farms in China, the mega farmers, the government has been quick to get them credit. You can say it's private banks or the government, but in China, that's the same thing. They have been living on credit, and that's why those losses have extended so long. Historically, by now, we'd see that Chinese hog market increasing in price because of liquidation. But because of good government credit, they've extended the losses. China piglet price, you can see how low those piglets are. That just tells you there's no real demand, no appetite for expansion, and I would suggest there's still continued liquidation going on in China. The news out of China is not good. The economy is weak. There's been a lot of buzz about that the last few weeks through Chinese New Year. Chinese government said it was a fantastic Chinese New Year. All the indicators are way above a year ago. But you got to remember, a year ago, China was going through COVID. They had lifted the COVID regulations December 11th, 2022. So by January 2023, February 2023, COVID was running rampant through China. And that was the big wave that really has put their economy into the shape it is today. Now, the Chinese government's quick to come out and say, we're going to fix this. And they came out January 23 and they said that they were going to, quote unquote, guide farmers to reduce hog production. They said capacity, but they're not talking capacity. They're talking the herd. They want to get this herd profitable. I have no idea how you guide farmers to reduce hog production, but never underestimate China and what they can do. Now, a downturn in demand led to those plummeting prices, mounting losses, and rising debt. And I would say it was also an increase in supply. So this article said farmers lost an average of $10 per hog in 2023. My estimate is they lost closer to $18 a hog. And so at $18 a head, they lose $13 billion. At their number, at $10 a head, they lose $7 billion. Now, the real estate story in China, you've heard of the big real estate developer Country Garden. That's the big weight on the Chinese economy now. They're concerned about this real estate blow up, potentially sinking that economy or causing real problems. Country Garden reported a $6.7 billion loss in the first half of last year. That's about what hog farmers lost in the first half of last year in China. And so these losses are big numbers. Even on a Chinese balance sheet, they're big numbers. And so we'll see where this goes, right? The government's quick to put out numbers. They just put out a number this last week showing that the swine herd was down, but I just don't have any confidence or trust in those government numbers. the best indicator of what's going on in China is the live hog price and trying to anticipate and guess about liquidation. And so these big losses suggest liquidation is continuing. China has some big challenges ahead. They have poor demand from a weak economy. They have overproduction based on that easy credit to the big companies. They continue to produce at losses. How long can the easy credit last? Someone suggested infinite credit. I had to remind them there's no such thing as infinite credit, right? Credit is always finite, and there's no infinite credit even in China. And so I think there's going to be some kind of reckoning. The government's put a heavy emphasis on those mega farmers, but even if you add up the total of their numbers, 70%-ish are still small farmers or mid-sized farmers in China. Those guys lack some of those government benefits. They're probably liquidating faster. The big guys lack the desire to liquidate. They've all been in growth mode for years. They have big asset bases. They want to hold out. They know this market cycle is going to turn. The challenge is, can they continue? Those extended losses into 2024 are going to make some tough decisions for Chinese hog farmers. I would not be surprised to see one of those big guys, at least one of those big companies, change hands, go into bankruptcy, have some problems this year. And I think if we do, if we see that, it'll be in the first half of the year. All right, more on China's economy. So this is just some of the economic data that's come out the last month or so. Things are tough. And all the data is tough in China. And the question is, what does a weak Chinese economy mean for meat and poultry? And I would tell you this, even with the current economic headwinds, Chinese demand for imported meat and poultry should remain relatively stable. And 23 was an example. I'll show you in just a minute. 2024 may be a tale of two halves. The first half, I don't see anything changing with Chinese demand for beef, pork, and poultry imported. I think the beef market's still abundantly supplied. The economy's weak. There's just not a lot moving there. Plenty of hogs. The second half is where we could see something. That doesn't mean we will. If we're going to see some shifts, we'll see it in the second half. And the key thing to watch will be that Chinese hog price, especially the next 3 months, which is typically their lowest demand of the year. And so if you see that Chinese hog price go lower the next 3 months, typical normal decline, then that tells me they've got plenty of hogs. Probably not much going to happen the second half. If these hog prices start holding steady the next 3 months or even going up, that's a pretty good indicator that supplies are going to tighten here in the second half. Global economic growth, particularly in the US and Europe, is so important to China's economy. Europe's economy is not doing well. The US economy continues to struggle under this heavy inflation. We're still staying above this 3% inflation, which is making it tough, but not as tough as everywhere else. I think the US economy will outperform most global economies. The question is there enough economic growth in the US and Europe to really fuel that demand for Chinese everything, right? iPhones, electronics, fill in the blank. And I think it's going to be a tough year in the Chinese economy. Now, 2023 was a tough year in the Chinese economy. And so I look at this and I go, you know what? That poor economic growth in 2023, they still imported over 6.5 million tons of beef, pork, and poultry. And so that was a weak economy. Of course, you can see the big blow up during the ASF years. But if you ignore those two ASF years, 2023 was not a train wreck, and that was with a very weak Chinese economy. The reality is the Chinese market for imported meat is massive, and 7 million tons spreads very thinly across 1.4 billion people. We've actually seen demand for US beef, quality beef, stay pretty strong even through 2023. And so even with a weak Chinese economy, I don't see any kind of wreck here. I think they're still going to import meat and poultry. The question will be, where can they get it from, especially for beef, because these beef supplies are going to tighten quickly this year. All right, let's go from China over to Brazil. We followed the Brazilian pork markets for years, and there's always been a little bit of a chatter. When's Brazil going to crack into these global markets? But if you look at Brazil's pork exports, you can see there from 2018, they were just over 600,000 tons, almost to 1.2 by 2023. That's almost a doubling, right? They nearly doubled in 5 years. Brazil's pork exports are doing well. Now you can see there a lot of that was China, But the last 2 years, they've actually declined shipments to China while still increasing total exports. Brazil shipped 28,000 tons of pork to Mexico last year. And if there's something that should concern us a little bit on the global markets, it is Brazil getting friendly shipping pork to Mexico, because Mexico is absolutely critical to the US. It's 40% of our total export volume. It is fresh bone-in hams crossing that border every day. And so something to keep an eye on. But as you saw a couple months ago, the Brazilian or the Mexican hog industry pushed back on that pork. And they actually got the government to stop importing Brazilian pork. That debate is ongoing. There's supposedly a meeting this week. They're going to talk about that. We'll see where that goes. But Brazil is nudging into that Mexican market, and they're nudging in. You can see they're into the Philippines, into Chile. They are making some inroads into some of these lesser markets. And I'll tell you about another one here in just a minute. So from Brazil, let's head back over to Japan. Japan has long been such a key focus for the US pork industry. Critical market, right? It's a good loin market. It's a good picnics market. We send a lot of everything to Japan, some of our highest value exports. The challenge for Japan is this. You can look and see, while the Mexican peso is up 16% in 3 years, the Japanese yen is down 30. The Japanese yen has lost 30% of its buying power for US goods in 3 years. That has been difficult, and it's due to that weak Japanese economy. If you saw 2 weeks ago, the Japanese economy moved into recession. And so things are not good in Japan. But when it comes to imported pork, they're paying a heavy price. If we look at from our standpoint, the blue bar is the cost of imported pork into Japan in US dollars. And we look and go, hey, over the last 2 years, US pork's got a lot cheaper. The red line is what they have to pay when they're paying in yen, which they are. And so we can say, oh, US pork's cheaper. In that green box, you can see they go, no, it isn't. Not with a 30% decline in the yen. Your pork is now very expensive. And that led to a 6% decline last year in total Japanese pork imports. Now, take a look at this. Here's the imports into Japan by country. Canada had a gain. US down sharply. Europe was down 18%. And who is the biggest gain into Japan last year? Brazil. Tiny little market. They're 3% of Japan's imported market, but they were the biggest growth supplier into Japan last year. Now, that should raise a little concern, right? Brazil is finally starting to get a little bit of traction. And again, it's only 3% of the market. It's small, but it's growing. And here's what those Japanese pork imports from Brazil look like. You can see there, it's really been over the last 2 years. They're buying a little more. And that average import price per pound is declining. And so Brazil doesn't have that big currency penalty that US does, like Canada does. And it's definitely given them a foot in the door. It's probably cheaper product. My contacts in Japan suggest it's for manufacturing type stuff, sausages, those kind of things. But Brazil is cracking into this market. Now, another reason Japan was so weak this year, the yen was weak. They had big stock levels. If you look at 2023, last spring, they had the biggest inventories they've ever had of imported pork, 225,000 tons. Now, because of that weak yen, they've been living a little bit off inventory. Now, that's good news. They're finally whittling down that frozen inventory. When that frozen inventory gets tight and they have to come back into these markets, we haven't talked about Europe yet, but Europe is somewhat absent here. And I think we're going to see some better action into Japan in the back half of this year as those inventories get tight and the US continues in this strong competitive advantage against Europe. So while we're on the point of Europe here, let's go ahead, transfer over to Europe. It's been shocking to see what's happening here. I was in Europe a couple months ago, well, this last summer in the Netherlands. Do not underestimate the European drive for climate at all cost. Climate policy, animal welfare, this is reshaping the European swine industry. Take a look at this data. This was a 2-year change. The European Commission still does not have 2023 year-end data. but it is going to be lower. So we're looking at 2022 to 2020. Spain was up 4% over 2 years, down 1% over 1 year. Germany, the swine herd's down 18% in 2 years. Denmark, one of the major hog suppliers of piglets into Europe, down 14%. Netherlands down 7%, Poland down 18%. You can see what's going on here, right? The EU Commission came out and said, we think the EU swine herd is going to be down 10% over the next decade. Well, that swine herd was down 10% in 3 years. It's going to be further than that. And so the EU sow herd is now down 9% in the past 2 years. And you can see what's going on. And this really is, it's climate policy, it's animal welfare, it's the Russian invasion of the Ukraine, which cut off through sanctions a huge amount of diesel and energy out of Russia into Europe. It is huge cost inflation. It's huge government policy. And the producers are just simply walking away. So if you look at European prices versus the US right there, you can see European hogs are now $23 a hundredweight over US hogs. And historically, that's how it is. Usually we have a $15, $20 price advantage over Europe. We have a $20 plus, and it's been going for a year. And so because of this cheaper hog market in the US, that heavily inflated hog market in Europe, and their tightening supplies, this spread is now very, very favorable for us. If we look at those EU exports here, you can see now down more than half from the 2021 peak. Europe exports about half, or about 10% of their production. So when their supplies tighten, they're not eating less pork, they're just exporting less. So they're tightening down those exports to supply the European market itself. And thus we can see they are truly pulling back from the global markets. Pork exports from Europe to the world were down 24% last year. 24%. This was the biggest pork exporter in the world. And in 2024, the US will surpass Europe and become the #1 pork exporter in the world, above Europe. Now I'm looking at Europe as a single country, right? But the US will overtake Europe this year in pork exports. So let's talk about the US. From the export side, you can see this chart here. And again, you cannot overstate the importance of Mexico. We are totally, completely dependent on keeping those hams going to Mexico. And what a growth market. It's absolutely incredible how much growth we've seen back in over the last 20 years. And you could argue a little bit that we only have one growth market on that chart. Now, all those other markets are growing a little bit, but there's one market that is significant. Now, in Mexico, they have been in liquidation. They've had high corn costs. As much as high corn costs hurt us, they hurt Mexico a lot more because they're buying US corn plus freight. And so they've had disease issues, they've had high corn prices, and US hams have found a new home in Mexico. The Mexican hog prices remain well above US hog prices today. I don't see anything really changing that. You can see I've got Mexico forecast another leg higher in 2024. China, Hong Kong, maybe a little bit higher, but that'll be in the back half of the year. And then a little bit of steady growth around the world takes us up. 6% is my forecast. We grew 8% in 2023. I've got another 6%. Why that's significant? I'm doing that without a lot of production growth, right? We know the US herd is not growing. US pork production might be up 1.5% to 2%. And so what does that mean from exports? So here you can see, as good as these exports are, they aren't as good as 2020 when we were sending all that pork to China. But 6.4% export growth times what, 25%, we export 25% of production, that absorbs 1.6% of production. Now, depending on what we do this year with production, this export growth may absorb all of our production growth this year, which would keep US production stable. That's good news, right? That's where these export markets can step in and support the domestic market. So if we can keep production or net supplies in the US steady through these higher exports, that gives us a lot better chance to try and go get some of that retailer leverage and be able to get margins back in order. All right, climate policy. Here's where it gets fun, right? I'm an economist and I run numbers and I look at numbers. And once you get out into this policy world, it's complex. But I would tell you this, the battle is real. Think about the past 2 weeks. I think it was actually 3 weeks ago in Europe now. But remember those protesters at the Louvre splattering the Mona Lisa with soup? They were actually splattering the glass in front of the Mona Lisa. It's not quite as dramatic as it sounds. But they were there protesting, saying we need more strict food or more strict climate commitments. We need more commitment to climate policy. That's why they were protesting. Just within a couple weeks later, we've seen the farm protests erupt and spread across Europe. They're protesting too strict of climate regulations. Europe has become this battleground now about what do you do over climate policy. I mentioned the conference. I was over there. These guys were saying climate at all costs, and it was an agriculture conference. It was the ag industry saying, "Hey, we have got to meet our climate commitments." What does that mean? Denmark said we're going to reduce livestock emissions 65%. Does that reduce your herd? Sure, but we got to do it, right? We got to meet the goal. In Ireland, we're estimating Ireland's going to take out 200,000 dairy cows to meet their climate goals. These guys are all in. And to meet climate goals, it's not just livestock. You've got to reduce fertilizer. Fertilizer is a big producer of greenhouse gas. And so they're legislating against fertilizer production. They're legislating against livestock. In Germany, what started these protests is they took the diesel subsidy away. There was a subsidy for farmers. It's what really got them through the situation with Russia. They said, we just can't simply afford to keep paying that diesel subsidy. I had farmers in the Netherlands tell me a year ago, they saw their power bills increase fivefold, 500% increase on your electricity bill. That's the cause, or that's the effect of that Russian invasion and the loss of that Russian crude oil and that Russian energy coming into Europe. That story is not over. They have not yet resolved that. And so these farmers are feeling huge inflationary costs on feed costs, on energy costs, on diesel. At the same time, they're getting hit with animal activism, and they're getting hit with these climate policies that are all out against them. And so this story's not over. The European farmers are going to be continuing to negotiate. They're still going to be trying to negotiate deals. The only negotiation I've seen them win thus far was one of the governments said, we're going to give you back pesticide. They were going to cut pesticide use, and they said, we'll give you pesticide. That's not what they're doing here. It's far deeper than that. And so I think these farm protests in Europe are going to continue. And the reality is these governments have some tough decisions to make about whether they want to impose this food policy on their farmers. Now, the climate debate is hot, and it's been hot for a long time. And this is the cry, right? We've got to save the planet by stop eating meat. Well, I went through the International Panel on Climate Change documents. This is their plan for greenhouse gas emissions. Now, watch closely here. That bar on the left, that's the base year of emissions. This is how they're going to get to 2050. This is currently. That's how much our emissions are. If we do nothing, the second bar is how much we're going to add. So by 2050, we're going to add that much more in greenhouse gas emissions, which gets us to the third bar. That's where we're going to be if we don't change anything by 2050. So the panel says, okay, you've got to cut. And here's all the ways we're going to cut climate or greenhouse gas emissions from livestock. The two biggest changes we can make right there, if you squint and look, I'll write them here, productivity and breeding changes. The two biggest ways by their own metrics of reducing our carbon footprint is by increasing productivity and breeding. Now, we're pretty good at that. A lot of places around the world are not. But if you spread that productivity around the world, you can reduce greenhouse gas output faster than anything. What about changing and getting people to quit eating meat? That's what it is. Dietary changes, fractional. But what's all the noise? The noise is all, you got to quit eating meat. If you eat meat, you're socially irresponsible. You're destroying the climate. By their own standards, that is a fraction of their reduction. The big reduction, productivity. Now, the good news for the swine sector, if you look here, This is the equivalent, CO2 equivalent per kilo of protein. Pork is pretty low. If you look right above pork at beef, beef is the culprit here, and also buffalo meat right above there. That's Indian water buffalo. Now on the beef side, the US is doing a very different job of this than the South Americans and others. And it all comes down to that word, productivity. Because of our productivity, our average cattle age at slaughter is 22 months, 23 months. In Brazil, it's over 40 months. And so there's going to be some more interesting debate, even on the beef side, about emissions and who's guilty of what. Now, if we look at the livestock and climate policy, originally the UN estimated greenhouse gas emissions at 18% of total emissions. They came out in that report, Livestock's Long Shadow, and they said livestock accounts for more greenhouse gas emissions than the entire global transportation system. There was a retraction printed, but never publicized. They actually trimmed it to 14.5% when their math was criticized. Right? We're seeing a lot of math that was driven by activism. There were a lot of activists doing the math on this, overstating it. When they went and put pen to paper, said, wait a minute, you've calculated wrong. They said, oops, we'll put it at 14.5. 2022, they then were forced to take it down to 12. Look at the US. Consensus estimates are that livestock emissions constitute 11 to 17% of global greenhouse gas emissions. In the US, the EPA estimates them at 4% of our emissions. Beef is at 2.2, dairy at 1.3, and swine at 0.5%. Right? This number's getting smaller. The better data we get, the less activism-driven data, the better analysis we get, we realize this story is diminishing. Now, that isn't, you don't feel it. It's not diminishing in the public forum, but the data is diminishing. There was an article that the UN admitted that their report was exaggerated on the impact of eating meat on climate change. My question is, do we see a softening? As this data becomes more precise and less one-sided, as we get new methods of dealing, and there's a lot of things we can do to reduce methane emissions from livestock fairly easily. There's a bunch of different new things coming out. There's feed additives, there's putting a digester over your lagoon, there's additives to the lagoon, there's all kinds of things we can do. And as we see the folly of these draconian policies in Europe and elsewhere, New Zealand passed a law to tax cattle owners beginning in 2025. If you own a cow in New Zealand, you get a tax bill from the government for your greenhouse gas emissions. Not consumers, they're taxing producers. However, that law was passed. There was a coalition developed in the New Zealand government that thinks they can get that overturned. You've seen the EU farm protests. I just wonder, are we going to see a little bit of a softening, especially when we see Europe making these hard decisions? Because if they truly reduce their output, they're simply going to be bigger exporters or bigger importers, mainly from Brazil, where they're going to be critical of deforestation. The reality here with climate policy, there's a stick and a carrot. And I think what we're seeing is a global pushback against the stick being legislation. The carrot is incentives, carbon credits, those kind of things. And I don't think that's over yet. I think there are going to be opportunities actually for farmers that can show a reduction in emissions to lease out those credits. I still think that's going to be an opportunity. Not maybe what you want, but a much better deal than flat out legislation. So I'll take a deep breath. Let me run down here what we've talked about. The North American margin outlook improves. Liquidation is still slow, and I don't think we're going to see much more liquidation. We got a little glimmer of hope in the futures market. I don't think we'll see that. I think this improving outlook slows liquidation maybe a little more. Global pork and protein supplies are truly tightening, all in sync. Not in a huge way. Beef is going to be significant, but that global protein pie shrinking is positive as we look out the next 3 to 5 to 10 years. I think we're going to see better margins in global livestock. The EU liquidation is significant. It's structural. It's not a cyclical liquidation. Even Spain passed a law that within 2 years, all their farms have to comply with new standards. It's tough in Europe. Weather and margins, always the key drivers to that. Exports will be supportive to the U.S. pork complex. I've been bumping my export forecasts higher. I think we've got a good year ahead based on that pullback from Europe. Higher prices and profits are out there in the future. Now, that's not a very bold statement. When in the future, right? For those who can endure the present, and you can look at the futures market and see a little glimmer of hope here over the summer. But we're going to see these feed costs. We'll see what we do on a grain crop this year. If we can get these feed costs down, if we can keep this export demand holding our domestic supplies a little tighter and go after some of that retail leverage, I think we can see a lot better outlook in the second half of this year. Always threats and opportunities. China, I'm not banking on China to save us here. We may see some action on China in the back half of the year. We may not. But the reality is the U.S. pork remains the cheapest, most affordable pork on the planet. We're very productive. We're very efficient. And I think there's a good future ahead. With that, I'll go ahead and wrap it up. Appreciate everybody jumping on today, and thanks for your time. Feel free to send me any questions. Thanks.